This question, Paulo, sole trader income statement question, came from the 2022 paper 1, so 7127-1. And it's all about adjustments. So we've been given some balances and we've been asked to prepare an income statement. And this is a 14-mark question that came from section B. So let's just have a read through the information. Paulo is a sole trader, trading as Cluedo coffee. A trial balance has been extracted, so we can see here that we've got all the usual suspects. But we've got things like purchases and revenue being on the same line. So obviously on the debit side, we'd have anything to do with purchases, so expenses as well, assets, drawings, credit side, income, liabilities, capital, that kind of thing. So purchases on the left, debit column, and revenue on the right. We've got rent payable and rent receivable. So rent payable, they probably mean rent paid. It's not a liability. That could be a bit confusing, but rent payable, that's the expense, the 9,600, rent receivable, 3,100. Receivables and payables, we're not going to need those, not for the income statement. The vehicles at cost and the provision for depreciation, we're going to need to calculate depreciation for the current year. So let's have a little read through. My advice with this sort of question actually is to forget about the income statement for the moment and actually just consider the adjustments that you need to make and make those adjustments in these figures before you start writing the income statement. So the inventory at the 31st of March, that's obviously going to be closing inventory. We'll need that for cost of sales. This figure up here is going to be your opening inventory. Goods returned to a supplier had been included in the purchases and trade payables at the purchase price of 4,200. Well, they've been returned to a supplier, so this is returns outwards, which is deducted in cost of sales. So let's make sure that with the purchases, we include returns out. It's going to be a credit. It's going to reduce the amount of purchases. And then the other half of that double entry is to debit trade payables to reduce the balance there. So if we were doing the statement of financial position or an extract from it, trade payables would be reduced. So we're debiting trade payables to reduce the amount we owe them, and we're crediting returns out. That's going to be part of cost of sales. You could deduct it straight from purchases. That would be perfectly acceptable. It's probably best to keep it separate. Okay, so that's number 2, one dealt with. The proceeds from the sale of a vehicle were recorded incorrectly as revenue rather than as a disposal of non-current assets. So that's alerting us to the fact that this revenue figure contains some sale proceeds of an asset that doesn't belong in there. It says that no other entries for the disposal of the vehicle have been recorded in the accounts. The vehicle was sold for £6,000 more than the net book value. So that means that we need to debit this figure, sorry, not that figure there, this figure here with £28,000. Okay, we're taking £28,000 out of the sales revenue. Okay, the net book value, so we need to deal with the vehicle cost, 49,500. That needs to be taken away from the vehicles at cost before we calculate this year's depreciation. We also need to find out how much depreciation has been provided on this vehicle. So if the cost was 49,500 and the net book value is 22,000, the difference is the depreciation provision. So all the depreciation that's been provided to date, 27,500. So we're going to need to take that away from the provision for depreciation before we start trying to calculate this year's depreciation charge. So let's work out the profit on disposal then. We sold it for 28,000. The net book value was 22,000. So we're going to have to include in our accounts a profit on disposal of £6,000. I don't know where I got the 500 from there. £6,000. So 22,000 was the net book value. 28,000 was the sale proceeds, which is the total of 6 plus 22. Okay, so remember, disposal of a non-current asset, the loss or profit on disposal is the difference between the net book value and the sale proceeds. Okay, so we'll need to include that, as I said, in other income. Depreciation of vehicles is to be charged using the reducing balance method at a rate of 33.33% per annum. Well, remember, whenever you see that, we need to divide the net book value by 3. Don't try and put 33 1/3 in your calculator. It's almost guaranteed to go horribly wrong. So the net book value on the vehicles is what's left here. So it's 83,000 minus the 49,500. So the cost that we're left with, because we haven't bought any other vehicles, is 33,500 minus the depreciation that's left. So that was 46,000 originally, but we've got rid of the depreciation on the disposal. So we're left with 18,500. So that means that the net book value is the difference between those two, 33,500 minus 18,500, which is £15,000 net book value. If we divide that by 3, then that gives us £5,000 depreciation. Okay, so we're going to need to add £5,000 depreciation into that, and then depreciation on the vehicle or vehicles is going to be £5,000. And then we've got depreciation on premises as well, charged using the straight line method. So the premises, 120,000. We can ignore the provision for depreciation brought forward. We just want 2% of that. 2% of 120,000 is 2,400. So depreciation on the premises, I'm sticking that in as well, so I don't forget to include it on my income statement, 2,400. The other bit of information is that the loan was taken out on the 1st of April 2021. Well, we're doing the year ended 31st of March 22, so that loan was outstanding throughout the whole year. We're paying 8% interest, so £50,000 times 8% is actually £4,000 in interest. And if we have a look down here, we can see the loan interest paid is only 2,000, so we're going to need to do an accrual for the difference of another £2,000. So we actually need £4,000 on our income statement for loan interest. Okay, so hopefully you can make some sense of my scribble there. Let's now stick all that into an income statement. Although we've done the hard work now, it should just be fairly straightforward, just remembering our layout. They've given us a title, so we don't need to worry about that. So let's start with the sales revenue. We have the original figure of 102,564, and we took off 28,000 that was to do with the sale of the non-current asset. So we've got 74,564 in there. Let's just check for returns. We're looking for returns inwards to come off of sales here. And we haven't got any, I don't think, but we have got the returns outwards. That's going to come off of cost of sales in a minute. So let's do cost of sales next. Make sure we label everything up. So let's start with the opening inventory, which has come out of the trial balance. So inventory at the 1st of April 2021, 16,276. Let's add the purchases to that. Now purchases I don't think changed. It was 43,451, but we do need to take off the returns outwards, which were 4,200. That was the goods that were returned to the supplier. And then the other thing we need to look for here is any carriage. If you've got carriage out inwards, it needs to go into cost of sales, the cost of getting the purchases in. Carriage outwards would be an expense. I don't think we've got any here, so we can go straight to closing inventory, which is always deducted. So closing inventory was given to us a note here, and we didn't need to make any adjustments to it. So the total of cost of sales then is going to be 16,276 plus the 43451 minus 4200 minus 12,304. So cost of sales is a total of 43,223. Now, before we do anything else, we need to find the gross profit and make sure that's labelled, because if we don't label it, we're not going to get the mark for it. So that's the difference between the sales revenue and the cost of sales. So it's 31,341. And before we start knocking off the expenses, let's add other income. So remember we had the rent that was receivable, which I think should actually be rent received, but we'll argue about that later, 3,100 in there. And we also had the profit on disposal of the non-current asset. So let's stick that in as well, £6,000 there, add those together. So 31,341 was the gross profit. Add on the other income. It's really important that we put the other income after gross profit, because we don't want it muddling in with that. We want to see how much the business has earned from its trading activities and then how much other income there was. If we start putting the other income in up here, it's going to give us a false picture of how much profit we're earning from our trading activities. We don't want that. Okay, so we've got this 4441, which is not labelled, doesn't have a name, but then we can do the less expenses bit. So I'd be inclined to sort of work through the trial balance, make sure we don't miss anything. So general expenses, we've got no adjustment to those, 15,043, so we can stick that in. The loan interest, remember we paid 2,000, but we need to do an accrual for 2,000 because there's a total of £4,000. So even though it's not been paid, we still need to include it in the accounts. What else have we got here? Rent payable, 9,600. Let's put that in. Rent payable, 9,600. Receivables and payables are on the statement of financial position, so we don't want to include those. But we do need to include both of these items of depreciation. Always a good idea to pop them in separately. The vehicle depreciation was worth a total of 5 marks if you got it right, so worth spending a bit of time calculating that properly. And then the depreciation on the premises, 2,400. So we've got 15,043, 4,000, 9,600, 5,000, 2,400. So the total expenses are 36,043. And then we can find profit for the year. And again, please make sure it is labelled, otherwise you will not get the mark for it. We can't present accounts to clients that don't show, things properly labelled. So the profit for the year for Paulo, for all his efforts, is not very impressive, 4,398. The second part of this question asked you to assess the profitability. So I'll probably do a separate video actually on the written parts of this paper. But if we just look at it quickly, he's made a profit of 4,398, but £6,000 was a profit on disposal of the asset, which isn't going to be happening every year. So actually without that, he would have made a loss. Also, he's got rent received there as other income. So his trading situation is not brilliant at all. He's got this loan interest. I don't know how long he's paying the loan off over, but it's a substantial amount. That's going to be eating into his profit plus the rent that he pays. So all in all, not particularly profitable. But as I said, I will record a separate video on that. Thanks very much for watching.